Well, this is concerning. Intel CEO, Intel, not the Intel, the deep state Intel. Intel Corporation CEO has said he's committed to dividends. You don't ever want to hear I'm saying that explicitly. So let's go to this is the financialtrends.com. My man David Greenberg. I don't know who David Greenberg is, but I check his stuff every day. So let me show you what I do. So just to give you a back story here, I go every day. I go to the Anonymous Conservative blog, and this guy crushes because he's a conspiracy theorist, and I like it. I actually enjoy it, get a lot of good stuff out of here. He's a big Trumpster, which I'm not, but anyway, but he starts every single and every day he does this whole just litany of various things in here. It's great that you won't see on normal media stuff, if that makes sense. Like here's Scott, yes, your boy Scott Adams. Just anyway, but he has a sponsor is the financialtrends.com. They always start about 4 or 5 articles are linked to financialtrends.com. And I always check the headlines and see what David Greenberg's talking about. All right, so this is interesting. So the CEO of Intel refuted rumors that hard times Intel is experiencing would lead to a rise at the end of the dividend payouts. In an interview with Yahoo Finance, the CEO, Gelsinger, said, "We are committed to the dividend and to a very healthy and competitive dividend. We're also making big long-term strategic investments, so we're putting all that together and looking carefully at the capital allocation priorities for the company overall, even as we remain committed." I hate those Apple pop-ups. I don't want them. Why did I get them? Anyway. In 2022, the company paid $6 billion in dividends to shareholders. However, the company's cash flow has fallen by about $14 billion compared to the prior year. And with fourth quarter results under pressure, some analysts asked if it's time to the company to do away with its dividend. Fourth quarter sales declined by a third. Woo, Nelly. Overall, the company had $14 billion in revenue. Adjusted earnings per share came in at 10 cents versus 19-cent estimate. Oof. The client compute. Okay, the stock declined more than 6% on Friday. All right, so I want to go to the Schwab's research sucks. I cannot believe Schwab doesn't have a better research page. I just want to see how much cash they have on hand. That's all I want to see. Schwab doesn't show it. They show current assets. Well, current assets doesn't mean cash, Schwab. So anyway, so we're going to go down here. We're going to look at the balance sheet. It drives me crazy. So we're going to go to, let's go down here. So look at net debt, 33, total debt, 38 billion. All right. That's a lot of debt, man. That's a lot of debt, but that's okay if we have a lot of cash to cover. So let's go to total assets, go to current assets. And we got 28 billion in cash. All right, that's good. And this is at the end of 2021, by the way, which is 5 billion more than they had in 2020, which is twice billion more than they had. They increased their cash by twice what they had in 2019. That's good, but the question that concerns me, frankly, is how much is their debt increase? So if we go to current assets, is really how much they have on basically receivables. We don't want receivables being a significant current asset. We want cash, and we certainly don't want inventory. We want cash. They got good cash. I like that. Enough cash to pay a $6 billion dividend. So that's good. I like that. All right, but then we go to current, let's see. I want to go to, 1 second. So here's our total debt. So it increased by 10 billion or so from 2 years ago. So our cash increased by 15 billion. Our total debt increased by 10 billion. So that in of itself isn't, that does make me, oh my goodness, we're all going to die. We're all going to die. Net debt is up. So, but they issued I guess that's 4 billion shares. So that could be where they're increasing their cash. Either way, their cash is growing. Their debt is growing. That is true. But that doesn't, in of itself, I'm not like, oh my goodness, they're not going to be able to pay their dividend. So I'm pretty okay with that. We want to go to, they got ratios on here. We want to go to current age. Let's go to income statement. So we want to look at, total revenue dropped. Yeah, that in of itself, that doesn't, I mean, look, revenue dropped and cost of revenue went up a little bit, but they're still making money. Gross profit, all right, they still have profits, all right, so that's a gross profit, all right, the gross profit, operating expense, operating income, pre-tax income, taxes, so they're net, so they're still making money. That's a good, we want to see them making money because that means they can still use the proceeds in which to fund the dividend. So that's good. So now that jumps at me like, oh my goodness, a huge concern of mine. Now, I mean, look, I don't own the stock. We'll go into here in just a second. And we're going to look, did I look cash flow yet? I don't think so. Anything jump out at me? Look at the income tax. But they don't pay any taxes, capital expenditures, issuance of debt. So they didn't really increase. I mean, they issued a lot of debt, but they also repaid a lot of debt. So the one thing, my friends, we want to be careful is there was a company, I forgot what it was, but they were issuing massive amounts of debt. And the reason they were doing that, you can see a mile away, is to keep their dividend paying. And you don't want that. You don't want to have a dividend. Look at those eyes. You don't want to have a dividend payable by debt. That's a no-win. That'd be like you transferring your credit card from point A to point B, point C to point D, and whatnot. Ultimately, you have to pay the bill. All right, so hold on a second. So in of itself, I was looking at it, I said, okay, that doesn't bother me so much. But there's a method, the reason I'm doing this video here real quick. I want to look at Intel. Actually, let's just go here. We can just go on Yahoo. Let's just go to summary right there. So stock's down 6.5% yesterday. And let's just go to the price to earnings ratio right now. Where is it? Right here. So 8. So that's, that's trailing 12 months. That's pretty cheap stock. They're still profitable. It's not like, was it, I can't remember, Ford or something like that. They're still making money. I'm not saying buy it. I'm not saying sell it. I'm not saying anything. I'm just showing you that. So they're still making money. And what's their current yield right now is about 5%. And that's not so bad. So they still got the cash to cover it. Now, one of the things I do want to look at, my VDIGX, I want to see if they hold Intel in here. I thought I just did that. All right. I thought I just clicked on view holdings. Maybe it's not working. Let's see. I want to view all holdings if it allows me. Oh man, it's only in the top 10. Now there's only 40 stocks in here. So okay, so it's not really gonna, the biggest holding they have, I think, is Target, right? TJX. I thought I clicked on view holdings. Oh wait, is that just going back a quarter? All right, let me go to Vanguard's website. Yeah, that's not. Okay, hold on a second. So I got 41 holdings. Does it not tell us the holding detail? There we go. All right. They only show us the top 10. That sucks. Oh, wait. Here we go. Page. Oh, sweet. Page 1 of 10. Okay. Oh, okay. Sweet. There we go. Cool. Let's just see if they got Intel in here. Ecolab. Oh, boy. Isn't that those clowns? That is the Ecolab, the guys who should be in orange there? Oh. It's weird they don't have Intel. It's crazy. I would have thought they'd have Intel in here. I guess they don't think Intel's gonna have growing. That's not what I want. I want holdings. No, that's it. All right, so they don't have Intel. That's interesting. Let's go to Wellington. They got $174 million of Intel at Wellington. All right, I don't know why everyone's saying Wellington is now a tech stock company. I was like, what? People say, oh, Wellington is a tech stock. It's heavy in tech. I'm like, where do you see that, man? Amazon, okay. Schwab, I don't know, Microsoft, I guess so. Pfizer, Coke, Progressive, McDonald's. I mean, you got a couple in there, but I wouldn't say they're, it's just weird to me, but whatever. I got a couple big ones in there. Amazon, Google, Apple in the top 5, but that's just weird to me. So if we go down to here, we go to the very next page. Duke, Novartis, Facebook, okay, Anthem, Cisco, Procter and Gamble, TI, Humana. It seems pretty spread across the board. So actually, I didn't know you could go to fixed. Ooh, let's take a look at their fixed income. Deutsche Tri-Party. I don't even know what the hell that is. Don't want to know. Don't tell me. Comcast, Dominion Energy. Oh yeah, Bank of America. I'm not saying these are good holdings or not. I'm just looking at the coupon on these bonds. You got 0 coupon on FHB or FHLB. But a California government obligation right there, 7.35. And then interesting. Face amount, 57 million, market amount 68 million. Pretty interesting. Anyway, the point about growing dividends is you have to have a company that's growing its dividends. And I think a lot of people, dividends are, maybe I should do a different video on this. But anyway, just remember, dividends are the ultimate in survivor bias. Bethlehem Steel no longer pays dividends. So if you own Bethlehem Steel, you inherently not a dividend growing. Now, if you eliminate that from the history, you can say, look at my growing dividends, it's done well. Well, yeah, but you can't avoid the losers you got in there. And people do that all the time. Anyway, so if a company's talking about doing something with dividends, it always makes me nervous. I just thought I'd share that with you. All right, love your thoughts. We'll see you.